Hey everyone, guess what? I just came across a long-lost clip of Charlie Munger sharing his wisdom on how to achieve 50% annual returns by investing small amounts of money. This clip looks like it was shot on an old iPhone, but the insights are pure gold. So, for you guys, I have filtered out the insights and laid down in this video. Let's get straight into you. Introduction to the concept. While having some capital is helpful, it doesn't take a fortune to start generating high returns on your investments. As Charlie Munger, the legendary investor and Warren Buffett's business partner, once said, the first $100,000 is a bitch, but you gotta do it. I don't care if you have to work at McDonald's and live in a cave, you gotta save some money. The key is to start small and be consistent. Even if you can only save a little each month, those small amounts will add up over time. So don't wait until you have a large sum to invest. Another important factor is to invest in assets that have the potential for high returns. This doesn't necessarily mean high-risk investments. There are many low-risk, high-return options available, such as index funds, dividend-paying stocks, and real estate. The key is to do your research, diversify your portfolio, and invest in assets that align with your goals and risk tolerance. Remember, building wealth takes time and patience. It's not a get-rich-quick scheme. But by starting small, being consistent, and investing in the right assets, you can achieve your financial goals without needing a fortune to begin. The most important thing is to take that first step and start investing today. 2. The question. Munger's response to the question about guaranteeing a 50% annual return with a small sum of capital like $10 million is both humorous and insightful. He emphasizes the importance of not seeking quick riches, but rather focusing on finding a few exceptional opportunities in investing. Munger suggests that instead of aiming for frequent high returns, it is more effective to concentrate on identifying and seizing significant investment prospects when they arise. By advising to act aggressively on these key investments and take substantial risks when the right opportunities present themselves, Munger highlights the significance of strategic decision-making in investing. This approach aligns with the principle of concentrated investing, where investors focus on a select few high-quality investments rather than spreading their capital thinly across numerous options. Munger's strategy underscores the importance of patience, diligence, and the ability to recognize and capitalize on exceptional opportunities in the market. In essence, Munger's response underscores the value of a focused and deliberate investment strategy over seeking quick gains. By concentrating on a few promising investments and being prepared to take significant risks when warranted, investors can increase their chances of achieving substantial returns over the long term. Munger's advice encourages investors to adopt a patient and opportunistic approach to investing, emphasizing the importance of quality over quantity when it comes to building wealth through strategic investment decisions. 3. Principle 1. Look in inefficient markets. In investing, Charlie Munger advised looking in inefficient markets. At Berkshire Hathaway, where Munger is vice chairman, the company is huge, worth almost $800 billion. Munger and Warren Buffett, the chairman, mentioned that their large size can limit their ability to make high returns because they can only invest in big opportunities. On the other hand, smaller investors have an advantage in finding mispriced opportunities that big investors might miss. By using tools like stock screeners to filter by market cap and PE ratio, small investors can uncover undervalued small companies that larger investors might overlook. By focusing on inefficient markets, investors can potentially find hidden gems that are undervalued or overlooked by the broader market. Munger's principle highlights the importance of thinking differently and seeking out opportunities where others may not be looking. This approach can offer a competitive edge to smaller investors who are nimble and can capitalize on these inefficiencies. By being selective and diligent in their research, investors can uncover promising investment prospects that have the potential for significant growth. Furthermore, Munger's emphasis on inefficient markets underscores the value of patience and discipline in investing. Small investors can benefit from taking a long-term view and not being swayed by short-term market fluctuations. By staying focused on fundamental analysis and the intrinsic value of a company, investors can make informed decisions that align with their investment goals. This approach can help investors navigate market volatility and build a resilient investment portfolio over time, ultimately leading to better long-term returns. 4. Principle 2. Take big swings. Charlie Munger has a principle about taking big swings when you find a great opportunity. He uses a baseball analogy to explain this idea. In baseball, one of the greatest players ever was Ted Williams. Williams was known for waiting for the perfect pitch to hit, the one that was in his sweet spot, where he could make solid contact and maximize his chances of getting a hit. He didn't swing at every pitch, but waited patiently for the right one. Munger applies this same thinking to investing. He says that you should wait for the perfect investment opportunity to come along, and when it does, you should invest a significant amount of money into it. Don't just put in a little bit. Go big when you find something that you are very confident in. Just like Williams waiting for his perfect pitch, you should wait for your perfect investment and then take a big swing at it. This allows you to really capitalize on the opportunities that you are most sure about. The key is to be very selective and disciplined. Don't just invest in something because it seems okay. Wait until you find something that you are truly excited about and believe has huge potential. Then go all in on it. This is how you can really maximize your returns over time. It's about quality over quantity when it comes to your investments. 5. Principle 3. Embrace a concentrated portfolio. Charlie Munger has a unique perspective on investing that often goes against conventional wisdom. One of his key principles is to not be afraid of a concentrated portfolio. This approach may seem counterintuitive, as most financial advisors recommend diversification as a way to mitigate risk. However, Munger believes that by focusing on a few outstanding investments, investors can achieve higher returns in the long run. To illustrate his point, Munger often shares the example of his friend John Arriaga, a successful real estate investor. Arriaga made a fortune by concentrating his investments around Stanford University. By deeply understanding the local market and identifying properties with strong potential, Arriaga was able to outperform the market consistently. His focused approach allowed him to make well-informed decisions and capitalize on opportunities that a more diversified investor might have missed. Munger's argument is that diversification can sometimes lead to mediocrity. By spreading your investments too thin, you may end up with a portfolio that performs averagely across the board, rather than having a few standout investments that drive significant returns. He believes that if you have a deep understanding of a particular industry or market, and you can identify truly exceptional opportunities, it's better to concentrate your resources and reap the rewards of your expertise. Of course, Munger acknowledges that a concentrated portfolio carries higher risk. If one of your investments underperforms or fails, it can have a more significant impact on your overall returns. However, he argues that by carefully selecting your investments and managing risk through position sizing and hedging, you can mitigate this risk while still benefiting from the potential upside of a concentrated approach. And that's it for today. By following these 3 principles from Charlie Munger, looking in inefficient markets, taking big swings, and embracing a concentrated portfolio, you can achieve higher returns even with small amounts of money. If you found this video helpful, make sure to like and subscribe. Let's continue learning from the world's greatest investors together. See you next time.